This is All India Radio. In the program Spotlight now, we bring you RBI Governor Shaktikanta Das's address on monetary policy decisions.
Namaskar. The Monetary Policy Committee met on 4th, 5th and 6th August for its second meeting of 2021, which is the 24th under its aegis, completing 4 years of its operation under the new monetary policy framework. The MPC sifted through domestic and global conditions and evaluated their unfolding impact on the overall outlook for India and the world. At the end of its deliberations, the MPC voted unanimously to leave the policy repo rate unchanged at 4% and continue with the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19 while ensuring that inflation remains within the target going forward. The marginal standing facility rate and the bank rate remain unchanged at 4.25%. The reverse repo rate also stands unchanged at 3.35%. I thank the MPC members for their valuable contributions to the policy decision taken today. In the MPC's assessment, global economic activity has remained fragile and in retrenchment in the first half of 2020. A renewed surge in COVID-19 infections in major economies in July has subdued some early signs of revival that had appeared in May and June. Global financial markets, however, have been buoyant, with return of risk-off sentiment inserting a disconnect from the underlying state of the real economy. Portfolio inflows to emerging markets have resumed and their currencies have also appreciated. The MPC noted that in India too, economic activity had started to recover from the lows of April and May. However, surges of fresh infections have forced reclamping of lockdowns in several cities and states. Consequently, several high-frequency indicators have leveled off. The agriculture sector's prospects are strengthened by the progress of the southwest monsoon and the expansion in the total area sown under Kharif crops by 13.9% up to July 31 over the previous year. Industrial production remained in contraction, albeit at a moderated pace in May. The Manufacturing Purchase Managers Index (PMI) shrank in July for the fourth consecutive month. Against this backdrop, the MPC was of the view that supply chain disruptions on account of COVID-19 persist, with implications for both food and non-food prices. The MPC expects headline inflation to remain elevated in Q2 2021, but likely to ease in the second half, aided by favorable base effects. As regards the outlook for growth, the MPC noted that recovery in rural economy is expected to be robust, buoyed by the progress in Kharif sowing. Manufacturing firms expect domestic demand to recover gradually from Q2 and to sustain through Q1 21-22. On the other hand, consumer confidence turned more pessimistic in July relative to the preceding round of Reserve Bank's survey. External demand is expected to remain anemic under the weight of global recession and contraction in global trade. Taking into consideration the above factors, real GDP growth in the first half of the year is estimated to remain in the contraction zone. For the year 2021 as a whole, real GDP growth is also estimated to be negative. Early containment of COVID-19 pandemic may impart an upside to the outlook. A more protracted spread of the pandemic, deviations from the forecast of a normal monsoon and global financial market volatility are the key downside risks. The MPC noted that in an environment of unprecedented stress, supporting recovery of the economy assumes primacy in the conduct of monetary policy. While the space for further monetary policy action is available, it is important to use it judiciously to maximize the beneficial effects on the underlying economy. At the same time, the MPC is conscious of its medium-term inflation target. Meanwhile, the cumulative reduction of 250 basis points is working its way through the economy, lowering interest rates in money, bond and credit markets and narrowing down the spreads. Given the uncertainty surrounding the inflation outlook and extremely weak state of the economy in the midst of an unprecedented shock from the ongoing pandemic, the MPC decided to keep the policy rate on hold while remaining watchful for a durable reduction in inflation to use the available space to support the revival of the economy. Living with the pandemic has improved the way we manage it, working from home, virtual meetings and contactless transactions. Throughout this traumatic period, one thing has stood out: the indomitable spirit of humanity, the inner conviction that whatever be the challenge, we have the innate resilience to combat them, overcome them and emerge victorious. I continue to be an eternal optimist, and I feel Mahatma Gandhi should inspire us. And in Mahatma Gandhi's words, if our resolve is firm and our conviction clear, it would mean half the battle won. Against this backdrop, I would like to highlight the impact of the monetary and liquidity measures so far taken by the Reserve Bank to mitigate the negative fallout of COVID-19. I thought it necessary to point out some of these aspects which are known, which are obviously available in the public domain. But I often hear questions being raised in the public space about the effectiveness of the rate cuts that the MPC has undertaken over the past, starting from February 19, in a more pronounced manner after the onset of the pandemic. It may be noted that transmission of the rate cuts by MPC would not have been possible to the extent achieved so far without creating comfortable liquidity conditions. The overriding objective was to prevent financial markets from freezing up, ensure normal functioning of financial intermediaries, ease the stress faced by households and businesses, and keep the lifeblood of finance flowing. This is achieved by infusing large amounts of liquidity in and out of the system through injections and absorptions through the LAF. In the process, the easing of financial conditions has actually enhanced monetary transmission and thereby the effectiveness of MPC's accommodative stance and actions. What is more, the injections of liquidity, including through open market operations, special operations, the open market operations, then special operations by way of what we call Operation Twist, the LTROs, the TLTROs, and the Forex interventions. This is very important to note. All this liquidity which are being injected into the market and which is there in the system, they are being fully sterilized by absorptions through the reverse repo while preventing a seizure of money markets under extreme risk aversion and uncertainty. Another aspect that needs to be recognized is that RBI's open market purchases are aimed at reducing funding costs for private sector entities that issue instruments in the market which are usually priced off the G-Sec yield as the benchmark. In fact, it is worthwhile to see who is benefiting from the RBI's actions. Borrowing costs in financial markets have dropped to their lowest in a decade on the back of abundant liquidity. Interest rates on instruments like the 3-month treasury bill, commercial paper, and certificates of deposit have fully priced in the reduction in the policy rate and are in fact trading below the policy rate in the secondary market. Let me now turn to announcing some additional measures. With COVID-19 infections rising unabated under fragile macroeconomic and financial conditions, we propose to undertake additional developmental and regulatory measures with several objectives, and they are as follows. Number one, to enhance liquidity support for financial markets and other stakeholders. Number two, to further ease financial stress caused by COVID-19 disruptions while strengthening credit discipline. Number three, to improve the flow of credit. Number four, to deepen digital payment systems. Number five, augment customer safety in check payments. And number six, facilitate innovations across the financial sector by leveraging on technology. These are the objectives behind the policy measures which I am going to announce today on behalf of the Reserve Bank. In the worst peacetime health and economic crisis of the last 100 years that we face today, the regulatory response has to be dynamic, proactive, and balanced. While designing the major announcements that I am making today, we have ensured that necessary safeguards are in place for preserving financial stability. We are fully mindful of RBI's responsibility to maintain stability of the financial sector. While I am outlining the main measures, the statement on developmental and regulatory measures will address them in greater detail. Among the various measures that I am going to announce, the first one relates to additional special liquidity facility. Additional special liquidity facility of rupees 10,000 crore will be provided at the policy repo rate to the NABARD and to the National Housing Bank. And this will consist of 5,000 crore to National Housing Bank, NHB, to shield the housing sector from liquidity disruptions and augment the flow of finance to the sector through housing finance companies. And it will also consist of 5,000 crore to the National Bank for Agriculture and Rural Development, that is NABARD, to ameliorate the stress being faced by smaller non-bank finance companies, NBFCs and macrofinance institutions in obtaining access to liquidity. The next announcement relates to resolution framework for COVID-19 related stress. The Prudential Framework on Resolution of Stressed Assets dated June 7, 2019 provides a principle-based resolution framework for addressing borrower defaults. Any resolution plan implemented under the Prudential Framework which involves granting of any concession on account of financial difficulty of the borrower entails an asset classification downgrade except when accompanied by a change in ownership subject to certain specified conditions. The Reserve Bank is also constituting an expert committee with the chairmanship of Shri K.V. Kamath, which will make recommendations to the RBI on the required financial parameters along with sector-specific benchmark ranges for such parameters to be factored into resolution plans. The next announcement that relates to restructuring of MSME debt. A restructuring framework for MSMEs that were in default but standard as on January 1st, 2020 is already in place. The scheme has provided relief to large number of MSMEs. With COVID-19 continuing to disrupt normal functioning and cash flows, the stress in the MSME sector has got accentuated, warranting further support. Accordingly, it has been decided that stressed MSME borrowers will be made eligible for restructuring their debt under the existing framework, provided their accounts with the concerned lender were classified as standard as on March 1st, 2020. This restructuring will have to be implemented by 31st March 2021. The fourth announcement relates to advances against gold ornaments and jewelry. As per extant guidelines, loans sanctioned by banks against pledge of gold ornaments and jewelry for non-agricultural purposes should not exceed 75% of the value of gold ornaments and jewelry. With a view to mitigating the impact of COVID-19 on households, it has been decided to increase the permissible loan to value, what they call LTV ratio, for such loans to 90%. This relaxation shall be available till 31st March 2021. The fifth announcement relates to banks' investment in debt mutual funds and debt exchange traded funds, capital charge for market risk. As per RBI's extant Basel III guidelines, if a bank holds a debt instrument directly, it would have to allocate lower capital as compared to holding the same debt instrument through a mutual fund or exchange traded fund. It has been decided to harmonize the differential treatment existing currently. This will result in substantial capital saving for the banks. It is also expected to give a boost to the corporate bond market. Number 6. We have a review of priority sector lending guidelines. With a view to aligning the guidelines with emerging national priorities and bring sharper focus on inclusive development, the priority sector lending guidelines have also been reviewed. An incentive framework is now being put in place for banks to address the regional disparities in the flow of priority sector credit. In conclusion, let me say as follows. At this juncture, the war against COVID-19 is most intense, and the world is bracing up for a second wave as it cautiously opens up. The pandemic poses a challenge of epic proportions, but our collective efforts, intrepid choices, innovations and true grit will eventually take us to victory. As Mahatma Gandhi had said, patience and perseverance, if we have them, overcome mountains of difficulties. The challenges of today will only strengthen our resilience and self-belief. We shall remain alert and watchful and collectively do whatever is necessary to revive the economy and preserve financial stability. Courage and conviction will conquer COVID-19. Thank you very much.
You were listening to RBI Governor Shaktikanta Das's address on monetary policy decisions. You can listen to it on our mobile app, News on AIR. This program is also available on our website, newsonair.com. You may email your opinion about this program at airnsdtalks@gmail.com.